This is exactly how I turned $20,000 of capital into $2K per month by selling options using one simple, high probability, rules-based setup. This can be executed month after month to generate consistent income. This is so beginner friendly that anyone, even with no options experience, can start to implement this and generate income just by simply watching this video, following the criteria and rules outlined. And what is this setup that I'm referring to? It is credit spreads. So I'm going to be breaking down the 3 key rules and criteria that need to be met in order to trade this consistently and generate the returns that I do. Now, before we go any further, I built every single one of you a credit spread trading blueprint. It's completely for free. It is the first thing in the description below. You can grab that now. So I first want to start with what credit spread trades actually are, for those of you who don't know what they are or don't know how to trade them. A credit spread is basically a two-legged trade where you have a short put followed by a long put that is your protection, and the difference between the two strikes is your spread. Now, you know exactly what your risk is and exactly what the credit is when you're getting into this trade. It's not like there's any guesswork. You know exactly what you're doing when you place the order, and you're going to be placing this spread, at least in the way that I trade it, very far down from the current price. So you're going to receive a credit to make sure that it basically does not break down below your short strike, and as long as it stays above that level, you will have made full profit on the trade. It can even trend down and go against you. As long as it doesn't go below your short strike, then you win the trade in full profit by the end of expiration. So it's basically just predicting that the stock will stay above a certain level for a set period of time. That is how credit spread trades work. It may seem simple on the outside, but this is where most beginners mess up, and it is strike selection. So let's dive right into that. This is one of the most important things that you can do when trading credit spreads, because if you go too aggressive, you can wipe out an account extremely quickly. So what do I do that allows me to generate consistent income month after month? Well, I go based off of probability. And in the options chain, there's this thing called delta. For those of you who don't know, delta has a couple definitions, but it also measures probability. So I trade delta 10 to 15 strikes. And what that means is my trades have an 85 to 90% win ratio simply by just placing the trade, not looking at any other factors that increase my edge in the markets. And we'll go into those in a second. So it's a very high probability setup from the start. Sometimes the delta 10 to 15 strikes can be anywhere from $20 to $40 to $60 below the current price of the stock, depending on the stock itself and what the implied volatility is for that stock. So if it's a cheaper company and it's maybe $80, then it'll probably be something like $20 below. If it's something like $300-$400, you might have a 50-60 gap between the price and where your credit spread trade is placed. So it gives you a huge cushion to be wrong. The trade can go down or the stock can go down and still not even have to come near your trade, and you can still make full profit. So that is the cornerstone of this trading strategy, is trading delta 10 to 15 strikes. Now, another thing which is really helpful, which is usually encompassed when you choose a delta 10 to 15 strike, is going outside of the expected move. It's another layer of confirmation that you want to have when taking your trades. Seeing what the expected move is for the time frame that you choose, and then making sure that your strike is below that. So for example, the expected move for 30 days may be $15 plus or minus. And if your strike is placed at minus 25, you have a $10 cushion of what is expected to happen and where your strike is placed. So it gives you another layer of confirmation that it is not going to go down to that level. So what we're doing here is we are taking smaller credits and making a little bit less money than we could be if we were going delta 20, delta 30, but we're winning way more trades. I tell you with absolute certainty that I rarely lose a trade. It's very occasional that a trade goes against me, and if it is, it's very easy to manage because I'm so far down. For me to roll it and for me to make it into a profitable trade is much easier, but I don't want to dive into that too much in this video. I just want you to know that you're setting yourself up for success when you go with the high probability setups that start with delta 10 to 15 strikes. Now, even if you pick the delta 10 to 15 strikes, if you choose the wrong expiration date, you can still lose all your money. So I have an example. There was someone I spoke to recently who was doing very safe strikes outside the expected move, delta 15, but he was trading them on 0 DTE and he had lost $40,000 over his trading career doing credit spread. So this is where choosing the right expiration date is an absolutely essential factor. Now, what do? I choose 30 to 45 days to expiration because it's proven that this is the the safest and best for option sellers. It gives you enough time where you're able to collect a significant amount of premium further out and down than if you were to be maybe on the daily or the weekly. So it gives you enough cushion because the further out you go, the more premium you'll collect. That's why if you look at leaps, long dated expirations, there's a ton of premium that you'd be receiving, but it's also sometimes 6-12 months out. So the sweet spot for option sellers who are trying to generate monthly income is simply just to go on the monthly to 45 data expirations. And that is really the key for doing this, so that you give yourself enough cushion and enough safety to constantly take winning trades. Now, the last thing you need to understand is that even if you choose the right strike and the right expiration, if you do it on the wrong company, you're still going to lose this trade. So this is the last and most essential thing that we need to go over, is which companies you're going to be trading this on. So I have a couple things that we need to go over. The first thing in order to do is to choose highly liquid, meaning there's lots of volume and open interest, and quality companies, a company that you wouldn't mind owning, even if you never end up owning it. So I personally have not owned a single company that I've traded in 2026, but in the back of my mind, I'm always trading companies that I actually like, companies that have good earnings, good future outlook and guidance. Things like that are really important because we want to do this on quality companies that will ideally be trending up or at least staying neutral during the time that we trade them, because this is the put side of things, right? So we're placing our trades below the price, predicting that it's going to go up. So that is really key. We don't want to be trading companies that are not quality companies. So we're going to avoid meme stocks, all that kind of stuff. Only quality companies is key to this strategy. You want something that's going to be around in 5, 10, 15 years from now. And another thing, and this is more getting into the technical analysis side of things, is choosing companies within a well-performing sector. So let's say there's a great company like software, right? In software, a software company in the start of 2026, you could have placed a Delta 10 strike and done it on a 30-day expiration and still lost the trade because of how software was tanking. So one thing you want to do is look at the correlating sector to which this company is a part of and see how is the overall sector performing, and avoid the ones that are performing badly, and at least go with something that is neutral and ideally bullish and performing well. That is going to be a key that makes this whole trading process so much simpler for you, is making sure that the trend is your friend. You don't want to fight against the trend. That classic saying stands true. And if you implement these three aspects, you are going to be putting yourself ahead of 99% of traders in terms of having a strategy that is repeatable, that will allow you to safely execute and just generate consistent income month after month without having to stress over trades, without having to manage losing positions constantly. Those are all things that happen to option sellers who go too aggressive. So you implementing this strategy will be on the winning side of things. You'll collect smaller credits, but you will be making more over in the long run because you're going to be winning a lot more trades. And that is exactly what I do in my strategy. And that is what's allowed me to generate 5 to 10K per month consistently. So once again, if you want to see my full credit spread trading blueprint, that is going to be completely for free. It is the first thing in the description below.